Welcome back to the Options Academy. The heart of the delta neutral trading is the adjustmental process. When the market moves and the position's delta inevitably becomes unbalanced, an adjustment needs to be made in order to bring the position back to equilibrium and the delta back to neutral. Clearly, since the market is rarely unchanged at the end of a trading session and due to time decay influence, the delta on any given position changes each day and is almost never completely neutral. Delta neutral traders do not adjust their positions every day. Rather, an acceptable range of delta is determined, or a predetermined range in which the underlying market is allowed to trade. Only once these levels are violated, an adjustment will take place. Let's examine a scenario where a gradual bullish trend is developing. As the market moves up, the delta of the calls become closer to -1 as the market nears the short call strike price. The delta of the puts, on the other hand, become closer to 0 as they become further out of the money options. This will be manifested in call premiums gaining gradually more and more on a move up, and put premium deflating less and less on the same move up. If no steps are taken to bring back the balance, the delta on the puts will become so small that a move up in the underlying market will result in nothing but a minute change to the put premium, therefore providing no balance against the call spread. There are several corrective steps a trader can make in order to bring back symmetry to the trade. We will briefly note 3 possible adjustments. 1. Selling more put spreads. Selling more option spreads and bringing more put premium into the equation will balance the delta. Some traders like to add on to the existing positions, while others prefer replacing the existing spreads that lost most of their value. For instance, let's assume that you sold a call spread and a put spread and collected 4 points on each for a total of 8 points. The market moves up and your call spread gains 1.5 points, while your put spread loses 1.5 points. So far, your delta is pretty much neutral, which is showing, in fact, that your overall Iron Condor balance has not been disturbed. It is still valued at 8 points. Now, however, your call spread is closer to the underlying market than the put spread. The delta on the call spread is higher, and therefore, when the market moves up again, your call spread gains 1.5 points, while your put spread loses only 1 point. Your delta, even though somewhat out of balance, is probably still at an acceptable range. The market moves up again, and this time the call spread, which is significantly closer to the underlying market, gains 2 points, and the put spread loses a mere half a point. At this level, you would need to take action if you wish to bring the delta back into balance. First, because the delta on the call spread is now much higher than the delta on the put spread. Second, if you take a look at your put spread, you will discover that it lost most of its value. During the first move up, your put spread lost 1.5 points. During the second move up, it lost 1 point, and during the third move up, it lost 1/2 of a point. If you sold the put spread for 4 points, it is now valued at 1 point only. Not only did you make 75% of the maximum profit on the put spread, but now, if the market continues to trend up, the put spread will not lose much more value to offset the loss on the call spread, which will gain value against you. Therefore, to return the balance to the Iron Condor and to provide yourself with more defense from a bullish market, you would simply sell another put spread and collect 4 more points. Now, if the market continues to climb, your new put spread will lose value and help offset some or all of the loss you're experiencing from the call spread. 2. Rolling the spread. Rolling the spread can mean several things. Some traders do not like to simply sell more spreads in addition to the existing spreads they already sold at the inception of the trade. Rather, they prefer to close the first spread they sold and then sell another spread. This action is known as rolling the spread. In our example, that would mean closing the first put spread we sold, and only then, or simultaneously, selling another put spread to bring in more premiums. Rolling the spread can also mean rolling the call spread. That is, closing the call spread, which is gaining value against us, and selling another call spread at a higher level in the same month or a month farther out in time. Since the delta increases as we near expiration and decreases as we go farther out in time, rolling the spread out in time will result in lower delta. 3. Narrowing the spread. If you do not want to sell more put spreads, making the call spread narrower will result in more balance to the Iron Condor. This occurs by bringing the long call option with positive delta and the short call option with the negative delta closer together. This action will lower the overall delta of the spread. Here, too, there are 2 ways to act. The first, narrowing from the bottom, buying back the short option and selling a new call option a little farther out of the money. The second, narrowing from the top, selling the long call we own and buying a new call closer to the money. For example, if you sold the 1050 call option and bought the 1080 call option, narrowing from the bottom up will mean buying back the 1050 call and selling the 1060 call. The 1060 call, being farther out of the money than the 1050 call, has a lower negative delta, and therefore the delta on the entire call spread will become lower, bringing some balance to the Iron Condor. Narrowing from the top would constitute selling off the 1080 call that you own and buying the 1070 call instead. The 1070 has a higher positive delta than the 1080 call, and therefore again will lower the overall delta of the call spread and bring more balance to the overall trade. Both actions, top to bottom or from bottom up, include paying some debit, since the new options are more expensive than the old options were to get out of. Narrowing from the top down costs less. Narrowing from the bottom up costs more, but also increases the probability of a winning trade to some degree because it pushes the entire call spread up by 10 points. Both ways of narrowing bring back some more balance to the condor and neutralizing the delta to some degree or another. So both ways of narrowing also reduce the risk on the call spread. Now instead of having a 30-point call spread, you have a 20-point call spread. With this note, let's conclude our presentation. To recap, many traders adopt non-directional trading approaches, trading with little regard to market direction. Selling options and specifically constructing delta-neutral option strategies such as the Iron Condor allows us traders to be less subjected to market direction influence as they focus on the advantages of time decay. The greatest challenge facing option sellers who use delta-neutral principles might very well be the adjusting phase. Traders who implement the Iron Condor concentrate on keeping the overall position in delta-neutral, thus allowing time decay to prevail as they inevitably near expiration. Here's to your success, and remember, there is substantial risk of losing in trading future options. Remember that past performance is not necessarily indicative of future results, and remember that only risk capital should be used. I hope to see you again soon.